Hello and welcome everybody. Happy Friday. We have made it to the end of another week and we have another lesson for you all. I'm here today to talk about a topic that makes a lot of sense given everything going on in the market right now. We're seeing a lot of market activity following the election and the inauguration. And now I want to talk a little bit about what market correction is. Correction is something that is a big scary word because it means that the market is losing value or that something is losing value. But I'm going to show you why sometimes that's a good thing. And we're going to talk about what it looks like both in the market, what it looks like for a stock, and we're going to look at what a stock may do after a correction that will give us a lot of information about what the correction was, as well as where we're going from there. So before we get on with the presentation, I do want to welcome everybody we have with us today. Hello, Blaze, who is here super early and ready for the class. Hello, Veronica, Silvia, Iris, Eddie, Andrew, Maida, Berta, Consuelo, Kike, Mabel, Rosa, Delia, and Cidia. Thank you all so much for being here with us right on time. And I'm not going to keep you waiting any longer. Let's get to the subject for today's class, which is market corrections. Market corrections, again, is a big scary word that you hear when the market's not doing so well. Hello, Juan and Jasmine. But we're going to talk about it in a little bit more detail today. So, as is tradition with these presentations, we need to start with what a correction actually is. And the simple answer, and we'll go into why it's the simple answer later on, but the simple answer is that it's a 10% decline, or the value of something goes down 10% from its most recent high point. So if say market is at $100 value, a 10% decline would be $10 off of the 100, so it would be when it goes down to $90. That is where we would consider us to now be in a correction. Now, corrections can apply to a single company, to an entire sector, or even across the entire market, or even the economy. And corrections can happen very, very quickly in a matter of days, or over months, and sometimes even years. And it really depends on how big are we talking here. Are we talking the S&P 500 has a correction? Are we talking that a stock didn't have a very good day or had some bad news or didn't meet their earnings expectations? These events can happen very quickly or can happen over a long time, as is the case with an economic cycle. We've talked a little bit about that in both our free and members webinars in the past, but it's this kind of tide that's always going on underneath the market of we can't always be in a good market. Sometimes we're going to be in a bad market. But the way that we look at it for that is peaks and recessions. And this word recession we're going to talk about in 1 second. But the last thing I want to mention about the basics of corrections is that while it's not necessary, while we don't need corrections, they can actually be a good thing by improving the market health, by giving us a better idea of what things are actually worth. We've heard about the market being on a bubble. And what happens when you're blowing a bubble? It gets bigger and bigger and bigger, but at a certain point, it pops. And that pop is usually what we see as a correction. And it's, again, not always a bad thing. But before we go too much further, I talked about a term, recession. So I want to clarify what the difference between a correction and a recession is. So there are different types of corrections. A standard market correction, and what we're going to be talking about today, is a sell-off event that is either 10% or larger of a drop in price or the value of a market. And again, this can happen very quickly or over a period of time, be it days, weeks, months, and it can apply to stocks, sectors, or even markets. Now, a recession is a much bigger event because it's not just a single bad day in the market or a bad week in the market. A recession is a decline in what's called the GDP, or gross domestic production. How much stuff does our country make? That is what GDP is. And when our production goes down 2 quarters in a row, so it has to be at least 6 months, that is when we consider ourselves to be in a recession. Now, because this is a market-wide thing, it's calculated by the GDP, which is a nationwide number. It only really applies to not even just one market, but it applies to the entire economy in of itself. And then the more severe version of a recession is a depression. A depression is a decrease in GDP that lasts at least 3 or more years. Now, in the last 100 years, we've only ever had one depression back in 1929. And that is the last and only depression that we've had. But we've had a number of recessions since then. But I do want to say one thing. We're not going to talk about recessions and depressions today, but we're only really going to talk about corrections. But that being said, I want to clarify what the difference between a correction and a bear market are. Because a recession and depression, they're about the economy. A bear market, as the name says, is about a market. It's market attitude of a market that is going down. So what is the difference between a correction and a bear market? Correction, as we said before, is 10%. That's the magic number. When the market goes down by more than 10%, that is now a correction. A bear market doubles down on that, quite literally. A bear market is a decline of 20% in whatever market we look at. But the main one, and what you'll usually hear it talked about, is the S&P 500. When the S&P goes down 20%, that is where we have a bear market. Like a correction, this is something that can happen very quickly. It can happen in a matter of weeks. And to give you an idea of how big of a deal this is, how often does it happen? Is it your average Friday in the market, or is it Halley's Comet that comes once every 50 years? Well, somewhere in the middle of the two. In the last 100 years, we have had 16 bear markets. And just to give you a couple of numbers, this is averages. So if we took all of the different bear markets we've had, added them up, and divided them by the number, this is what we would get. How big is a bear market? The average bear market has been a decline of 39%. The largest one we had was in 1929, which saw the market lose 86 or 89% of its value. Then the average length. How long does the bear market last? The bear market lasts 22 months. The beginning of that bear market is the high point. The end of the bear market is the low point. So from what's called peak to trough, that is the length. And the average is 22 months, just under 2 years long we spend in a bear market. 9 of the 16 bear markets have also either led to or been the result of economic recessions. Now, the one I talked about before, one of these bear markets, the 1929 correction that I just talked about, was a depression. So again, 9 of the 16 bear markets have also had recessions, whereas one of the 16 bear markets also was a depression. And to give you an idea of the last time this happened, before last year, the most recent one was in 2018. Lasted 4 months. Now, because we are here in the beginning of 2021, we can talk about the 2020 bear market that we experienced. It lasted only 32 days and had a decline in the S&P 500's value of 34%. And to this day, well, because we haven't had a bear market since, this is the shortest bear market that we've ever had on record. So since we started the stock exchange, the New York Stock Exchange, this is the shortest bear market we've ever had. It lasted 32 days from February 19th to March 23rd was those dates. So what actually causes these corrections? Tricky question to answer because it depends. It depends on, are you talking about a stock, a sector, a market, or the economy? But let me try and break it down into a couple of different groups, and then we'll go into more detail about some of the more common causes. So what causes corrections? When you're talking about a company having a price correction, that could be the result of a change in leadership at the company. Maybe a big person at the company leaves and the company's not too happy about it. A person passes away, or maybe that company was acquired by a bigger company, or maybe they acquired another company that's maybe not so good of a business deal, or maybe they released a product that either fell flat on its face or had batteries that like to combust into flames. Take your pick, but company activity can be a cause of a correction. Now, the next one should be a little bit more obvious, but global events, natural disasters such as fires, earthquakes, hurricanes, global health issues like pandemics, or political events like elections can all cause market corrections for both companies, which would be a stock correction, or entire markets like, well, the S&P 500. Then back to the company side of things, we have technical corrections. Remember, technical analysis is looking at the price of something. It may be that the stock price hits a resistance barrier and then turns around. It could be that a stock, investors, they were getting all excited about this one company. They all wanted to buy. Okay, maybe it's not worth what I'm trying to buy it at anymore. So the buyers stop buying. The sellers, they've already made their profit. They want to start selling. And then the price may correct to try and find what that company is really worth. And then, of course, humans' favorite emotion, panic. We are emotional. We like to have news, and that news sometimes causes us to go a little bonkers. So when that happens, the market will react because people decide what they want to buy and sell stocks for. Panic in the market can result in massive changes in price. That is why we have bubbles that burst. And when they burst, things get a lot worse than they really should be because no one knows where the bottom is. And when you're falling, maybe if you're skydiving, you know where the ground is. But if you're just swimming down into the deep, dark blue, you don't know where the bottom is. That can be scary, and investors don't like scary. So that is technical corrections. And then the last one is the most common, which is prices change. News, either good or bad, can lead to the change in price of a stock or of a market. And as investors try and figure out what that new price is, they're probably going to overestimate it and then underestimate it, then over, under, and we get what's called a ripple effect, where you have a rock drop into the water and it causes little waves. As the waves go further out, they get smaller and smaller and smaller until we get to calm water again. The same thing will happen with stocks. A big event is that rock splooshing into the water. Then the market starts to figure out, what is this new thing worth? It may be worth more, it may be worth less, but often the price jumps up and down as investors try and figure out, what is it worth to them? So what does this actually look like? Let's take a look at the 2020 market correction, or rather bear market, which is a type of correction. It's a larger correction, to see what that actually looked like and see if we can identify the dates in which it happened. So here is, and hopefully everyone can see this. I apologize if it's a little small, but this is the graph of the S&P 500. We're using the actual index, not the ETF. So we're using $SPX if you're on stock charts. And let's take a look at 2020 and find the high point as well as the low point that was our 32-day bear market. Right here, where you see the red arrow, is the February 2020 high point. It reached a market index value of 3350 was the high point that it reached. Then, as things in the world started to get a little crazier, the market went down. And I'm going to draw for you that 10% line where we have our correction. It's right there. As we can see, we went a little bit further than just our 10%. So that line shows where the correction was confirmed, but we see that the price continued to go down from there. So when or where is the end of that bear market? Well, just like the high point is the beginning of the bear market or the beginning of the correction, the end of a bear market is at the bottom of the price drop. Down here, right above the 2200 line. Sorry, I'll pause it here for a second. So that is market correction. This is looking at the S&P 500 and looking at the shortest bear market we've had on record. It wasn't that it was the smallest. It was pretty big. It was more than 30%. But it came and went like the wind. Moving on, let's talk about stock corrections, because that's where a lot of the fun stuff goes on. That's where we have a lot more to talk about. So stock corrections are a little bit different than market corrections because they can come from one thing, another, or a little bit of one and a little bit of the other. But what I'm trying to get at is that they can come from any of the causes we talked before. It could be that a natural disaster happened, and because of that, this company's supply chain, how they get their product, that got disturbed or that got broken. That's going to cause a stock price change, most likely a stock price correction. And again, as I mentioned before, this ripple effect. With stocks, there tends to be a ripple effect that follows any large change in price. Doesn't matter if it's up or down, when a large change happens, it's very likely that you're going to jump a little bit past it. Think about it like this. If I have a tennis ball and I bounce it, when I let go of the ball, it's going to fall and it's going to hit the floor. But it doesn't just fall, hit the floor, and stick there. It bounces back up a little bit. Then it'll fall back down again, bounces back up, a little bit less, a little bit less, a little bit less, until it settles down on the ground. Stocks will do something very, very similar, where the correction will be part of that bounce. It can either be the initial dropping the ball, or it can be if you threw the ball on the ceiling. Imagine if gravity went up instead of down. I threw the ball on the ceiling, and now it's bouncing off the ceiling instead. Let's put gravity back to normal and then move on a little bit. But what I'm trying to say is the correction can be the cause of the ripple. It can be that we're dropping the ball and it bounces up a little bit and then settles down at a lower price. But it can also come after the cause of the ripple. It can be an effect of that ripple. So let's talk about these two things a little bit more. First, let's talk about corrections as a cause. They are the reason that the price is changing and that we're even talking about this company or this stock. Stock corrections can come from any number of things. It can be from bad news. It can be because a company didn't reach its technical goal, its fundamentals that it was looking for. Maybe the price didn't get up to what investors were hoping it would. Maybe it hit a resistance barrier, but people didn't think it was worth that. It can be any number of things, whether one, another, or a little bit of both. Now, these corrections for stocks follow the exact same rule as market corrections. It is a 10% drop in price or more. Remember, it can be 10, it can also be 15 or 20 or 30% down. All it needs to do, though, is go at least 10% below its highest point. Now, I'm going to talk about some things that can happen. Keep in mind, this is not how it will always happen, and we'll go into some examples in a little bit here. But take everything I'm about to say with this can happen. It's not a guarantee. We never can guarantee or predict certainly that something will happen in the market or in the price. But when corrections occur, the stock price tends to bounce back up as the new stock's price is decided. What does that mean? It means that something changed. Say we have a stock that's worth $100, and that company, they didn't do so well. So investors don't think that company is worth $100 anymore. They think it's worth $90. They're not going to start selling until it's $90. They're going to keep selling until it drops to 85, 80 maybe, because they want out. They don't know where the bottom is. So what's going to happen then? The price gets down to $80, and now everyone that's been following the stock starts to say, all right, I think this is a good deal now, because the value that they see the company at is higher than the price the stock is currently trading at. When there's that difference, it can either be the price is too high, which means it's overvalued, or the price is too low, it's undervalued. It will then correct back up or rallies back up to eventually meet where investors think it's worth and what it's actually trading at. So I want to give an example, and we'll actually go look at this chart once the presentation's done. But Twitter's stock is a great example of this. In early January, there was some events that took place in the United States, and at the center of it all was Twitter. Twitter is a social media platform that many people use, but gained a lot of publicity and use because of very prominent people that were using Twitter as their platform to talk from. That changed. And when that changed, investors panicked because they thought that the value of Twitter was going to go away. Everything in Twitter's ecosystem has changed, and Twitter is about to lose all of their users and all of their value. So we had a correction. The price dropped 10%. But then what? A couple days after that, people stopped panicking and realized, Twitter's still here. They're still doing all right. And the price rallied just as much as it lost. Now, that rally was not immediate. It didn't gain all of its value back in one day. It took a little bit of time. It took about a week, week and a half. And we're going to look at that chart and talk about that and show that a little bit more clearly. But for right now, bear with me. Twitter is an example of a stock that bounced back up. Now, the stock price, I apologize. I'm getting my examples mixed up here. Facebook is an example of a stock that fully bounced back up. Twitter did not. Twitter's price dropped. And when it dropped, it didn't have a little bit of a bounce. It flattened out. There was some changes, some reversals, but it decided that there is a new lower price that Twitter is worth. I apologize for the confusion. But like I said before, stocks can also fully recover depending on the reason for the correction. Was it a drop in users or just a bad day in the news cycle? And that was what happened with Facebook in early 2021. In the first couple of weeks, as the new administration started to become a little bit more apparent, large tech companies panicked because they expect more regulation around social media and around the internet. And as part of that, Facebook stock took a 10% correction. However, there wasn't anything that changed with Facebook. Facebook didn't lose users like Twitter did. Instead, Facebook just had a bad day in the news. So over the course of the next week or so, Facebook corrected back up to the exact same point that it was at before it dropped. And again, we'll be looking at both of these charts after I finish up this presentation, because I'm also going to talk about a couple of other examples before we go over to stock charts. But what we've talked about now is two companies that the corrections were the cause of change. Now, what happens when the correction is just the answer or is just the result of something else happening? Let's talk about that. Stock corrections can also come as the result of what I said before is a price rally. The stock price goes up, goes past what people think it should be worth. And when that happens, when a lot of people start buying, the demand for that company that hasn't changed. So what's going to happen, and the supply hasn't changed either. So what's going to happen is the price is going to rise very quickly, but just as quick as it went up, it may go back down a little bit because often the price will go above what people think or what the company is really worth. So people will be buying and it will go buy, overbought. Then, just like a roller coaster, when it goes up, it's going to shoot back down, eventually hit a dip, and then come back up a little bit again. So when that happens, the corrections are the result of everyone at the top of the roller coaster throwing their hands up and saying, "Wow!" and going down. So obviously I miss roller coasters. It's been too long. So when this happens, corrections will be the result of that rally. And as the price balances out, as it goes up, back down a little bit, up, back down a little bit, up, back down a little bit. It's going to be going less and less and less and less until it flattens out at what investors think the new value is. A stock that does this almost on a weekly basis is Tesla. Tesla continues to skyrocket in price. It continues to change market conditions daily, if not weekly. But what will happen is it will go up. Investors will realize that it's overpriced, it's overbought. Then they'll start selling. They'll sell too much, and then it'll go to underbought or oversold. Then it'll go back up again, back down, back up. Then we'll have a breakout. And it will form what's called a triangle. It's these prices that kind of go, kind of go closer and closer and closer before it finally breaks up above the triangle or down below the triangle. So I just said a couple of chart patterns that I want to talk about in a little bit more detail. And those are cause, when correction is a cause, but also when a triangle forms. And these are what are called high and low poles, as well as triangles, either bullish or bearish triangles, depending on if it breaks up or down, respectively. So these are two chart patterns that occur frequently when we have a correction, regardless of if the correction is the cause or the effect. Now, high poles they're a short chart pattern because they'll happen in two columns. One column going up and then another one going down, or the opposite. One column going up and then another one going down. Sorry, I said that twice. Going down and then back up. So these corrections will form what are called high or low poles. Think of it like a flag in the case of a high pole. You have a long, big stick, and then you have the little flag that sticks off to the side. That's exactly what these charts look like. And they are the result of a breakout of at least 3 boxes or more. And then, after we have a breakout, remember, a breakout of 3 boxes or more. So that's a large change from the previous resistance or support barrier. We then have a reversal, either a correction or a rally in the opposite direction of 50% of the previous change. And don't worry, again, I'll go over some examples of both high and low poles after we finish up the slides. But that's the beginning. Sometimes they'll flatten out from there. They'll have a pole correction or rally, and then they'll go flat. Or sometimes the poles will turn into triangles as investors try and figure out what the new value of that company really is. Now, I want to take off your investor hat. I'm going to take off my investor hat as well. We're now going to think like economists. We're going to think and talk about supply and demand, because that is what changes in price really come down to. Supply and demand. How many people are buying? How many people are selling? So stock prices are often like a game of tug of war, where on one side you have supply that's trying to pull their way, and then you have demand trying to pull their way. And it's a never-ending game because sometimes one side's winning, sometimes the other side is winning. But what we want, and what always, well, not always, but often will happen, is that both sides will be pulling about the same as the other. So what will happen is we have the supply. That is the stocks that are for sale. And we have the demand, which are the people wanting to buy those stocks. Now, price changes happen We have these changes when there is more supply and the prices go down. Because if there's a lot more people trying to sell and not more people buying, well, what's going to happen? You're going to have a bunch of people that are trying to sell for $100, $100, $100, but then someone gets a little antsy. They're like, all right, forget that. I want to sell it for $95. Oh, I'll do 94, 93, 92, 91. And then the price starts going down because buyers want to get a good deal and some sellers just want to sell. So the price will go down until there's buyers and sellers that will agree on a new price. But what will eventually happen is, well, demand will eventually go up because people are getting a better deal. Now more investors want to buy. Think of it like this. If you went to the grocery store and they had some really nice steaks for $10, I'd maybe buy those steaks for $10. What if it was $30 though? I don't need it that badly. If it was $5, all right, we're freezing some of that and we're going to be eating red meat for a while. That will happen with stocks as well. You're not going to the grocery store to buy steak, but you're going to the stock market to try and get something that you think is good value. So let's now look at what this supply and demand, this tug of war looks like in the market. Because ultimately, a stock's value is nothing more than what people are willing to pay for it. So say we have a stock that's $120. Now, the price, that's what we think it's worth. The price is going to start down here at 114. 120 is right here in the middle. So the stock's price, because we think it's worth 120, but it's for sale at 114, we think that's a pretty good deal. So we're going to start buying and buying and buying. And we get so caught up in buying, we realize that we bought too much and it's now overbought. Investors are no longer willing to pay more than $128 per share, and some people are going to start selling. Well, no one wants to buy at $128, so the sellers start to panic a little bit. They're like, all right, well, how about 124? 122? No, 120. 118, 116. And the price is going to go back down to $116 because people are trying to sell. The buyers start to get closer and closer to their side. Well, eventually it's going to go back to overbought, then back again to oversold, and then we'll finally have our changes in price until we reach $120. That right there is our triangle. We have prices that are getting closer and closer and closer, closer and closer and closer to what the market thinks that stock is worth. So then we'll have our breakout. The breakout is when something new happens. We're not looking at buying an investment that is flat. We're looking at buying an investment that is going to return some profit or that we think is going to go up. So when this triangle forms, that means investors are getting closer and closer to what the market thinks and what investors think that share is worth. What if you're a little bit smarter than them and you think that it's really worth 126? Or maybe that stock has a really good day in the market and that stock starts to go up. We then have what's called a bullish triangle breakout, where our column of X's finally breaks above the triangle and breaks above the previous column of X's. We've come to the end of the presentation, and we're about to go into some real examples of all of this. But before we do, I want us to remember a few things. corrections are not always bad. Sometimes they're needed for a market to get from an overbought point back towards equal. And I both love and hate using this example, but I'm going to use it because it's very valid. Fires are something that happen. They are something that nature does when there is too much stuff, because it clears things out. It makes room for new growth and new opportunity. We also see fires as a natural disaster. They are tragic, but it is also clearing area for new growth, for new development, and for new opportunity. The exact same thing can happen with a correction. While they tend to be a negative impact in the short term, corrections can improve the long-term health of a market. And this is something that applies to market corrections. This does not apply to stock corrections, but market corrections have always recovered in the past. We have always been able to make back that correction and grow past it. And stocks can recover. It's not that if a stock has a correction, suddenly they're never going to be worth what they were before. But it's very dependent on the reason for that correction. Was it that they had one bad day in the news? Or that the company is going downhill? You never really know. But that's part of it, is that stock corrections can recover. And when they recover, they often recover stronger. But it's also possible that the stock has now settled to a new, stable, but lower price. And again, corrections can be the result of both the market trying to find a new price for a stock or a change in supply and demand. So they can be the result of changes, but they can also be the change themselves and can lead to a new, lower price that may take months or even longer sometimes to recover. Let's go look at some actual examples of everything we've talked about here so we can get a better idea of what these chart patterns look like. So we're going to go to our handy dandy stock charts, and we're first going to cover examples of our low pull and our recoveries. So we're going to look first at Twitter. Twitter, here we see a market correction that happened last year, and then a triangle, then a giant takeoff towards the end of the year. However, when all of this news broke out about Twitter earlier on this month, we see that Twitter's price went way back down from $57 almost. It went down to $46, a change of $10, about 17%. When it changed 17%, that's more than our correction. What's happened since then? We have what's now called a bearish pattern. It's not a bearish triangle, it's a bearish pattern, where we now have our double bottom breakdown, and we see that prices aren't bouncing back up immediately. This isn't just some fluke. This is an actual change in what investors feel Twitter is worth, which is why we see that the price has begun to stabilize. It's begun to flatten out between $46 and $49. So that is what a change looks like. We see a correction occurred, and then from there, we flattened out around that new lower price. On the other side of things, let's look at Facebook. Facebook had a large triple bottom breakdown in early January, but since then has reversed. So I'm going to take this screen grab right here, and we're going to make it a little bit bigger. So we can look at our 3 boxes. Give me that. So those are the 3 boxes that we needed to have our low pull, but it continued going down as we see here. Art class with John can sometimes be interesting. It went down even more and then bounced up. Here's 50%. That's the 50% line. So once it went above that line, once we got to here, that was our low pull reversal. So that is what a low pull recovery looks like. We had a large change of about $40 in price, which works out to about 14% change in value, before it bounced back up, returning to where it was before it dropped. Nothing changed with Facebook. The value of Facebook didn't change. As we see, it already had a big triangle pattern. And at the end of its triangle, it dropped down, but quickly and over the course of about a week, bounced back up. Lucia, the name of the tool that I use is called Giazzo. That is the name of the tool. So that is what it looks like when we have a price that is well established, that has a large, quick change, and just as quick as it went down, recovered. Iris is asking what happened to mRNA, or is that what happened to mRNA? We'll take a look at that chart after I go through these other examples that I have. So keep that in mind. I'll remember it as well, but if I forget, just poke me once or twice. I'll make sure that I remember. So the next one that I want to go over is low pulls that haven't recovered fully yet, but are still in their low pullness. So the first is AMC. AMC, being a movie theater, had a really rough 2020 because, well, no one wants to go to the movies right now. So what's happened is the value has gone down significantly. So when the value went down, we had a low pull, which was this drop right here, of 50% of the value of the stock. This one line of O's represents 50% of the value of that stock. But investors think it went down a little bit too much, so it's begun to reverse back up. The reversal point was right here at the $3.25 line, and it is now corrected back up to $3.51. We don't know what will happen from here. It may turn back down and begin forming a triangle, or it may continue to go back up to where it was before. It all depends, and we never know for sure. That is why doing research to figure out why a price change like that happened is important. It's important to know, did something change with the company, or did something change in the news, or what people think of that company? I want to now look at a high pull, which would be Anthem Inc., the healthcare company. Here we see there was a breakout of 4 X's above the previous column. It went 1 X above its previous high. Then investors realized it may not be worth what it's trading at. So it corrected back down past the $324 mark, which was the trigger for the high pull, and has now gone down to $314. And again, it may continue to go back down, or it may go back up and begin forming a triangle. Now, one of the last ones I want to look at is a company that they really like their triangle patterns, and that is Tesla. I feel like I can never go a single presentation without talking about Tesla, but you know, it's kind of a newsworthy stock. What's up?
The questions.
Yeah, I know. Oh, one of the questions is about the Facebook chart. Let me make sure that I can answer that when the charts decide that they actually want to load for me. Okay. There's a question of why did the line here, why didn't it reverse into red? The reason I can see for that is that here, let me grab this and I'll go over to Giezo so it's a bit easier. So this blue line right here is supposed to be a straight line that goes until it reaches an O. When it reaches an O, we then would have a red line that goes from that high point down. I honestly do not know why there isn't this line, because it should be a reversal into a downtrend. The only thing I can think is because it was only one box, that it was a short enough change. Because remember, these blue and red lines are long-term trends. Because the long-term trend immediately changed, it's likely that it was too short for it to cause a red line. But I do not know for sure. Let me do a little bit more research to see if I can come up with a better answer for you, and I'll make sure that I talk about it next time. If my pen wants to work. All right. Why did Facebook not have? Great question. Thank you for that. I will make sure that I follow up about that. Okay, let's go look now at Tesla so I make sure that we have time for mRNA after. So Tesla likes its triangles. Let's see if we can find some, shall we? That's a very thin line. Más fuerte, por favor. Okay. Here's one triangle. It has to go one box above the diagonal. Thank you. That is really useful to know. Thank you so much, Mom. So here's one triangle. Here's another triangle. Here's another triangle. And here's another triangle forming right now. So these are, in most cases, bullish triangles. Let's see if we can track what the results of each one was. Bullish, so it broke out above. Bullish, bearish, because it broke down right here. And now we're forming another triangle. So Tesla is a stock that historically has had a lot of triangle patterns. Not all of them have broken up or down, but when Tesla hits the news, it is highly volatile. The stock's price changes very, very, very quickly, and it reacts a lot to the news, both good news and bad news. So let's go now and take a look at mRNA, which, if I can get this to go away, no, leave, I don't want you anymore. All right, it's just gonna stick around. Okay, there we go. mRNA is Moderna. Let's take a look at what's happened. So let's go through a few things about Moderna. They have been working on a COVID vaccine that has hit the market, and that is the result. And we see the results of that right here in November as the vaccine took off. However, since then, there has been a lot of issues getting the vaccine out and the ability for that vaccine to be used as much as it should be. Also, there are other competitors that have been working on other vaccines that are coming out with a lot of noteworthy news right now as well. And because of all of this, the stock price has been going up and down a lot based on the current events that have been going on. That being said, as vaccinations have begun to pick up, we see that the price right now is in an upward bullish trend. So we see that we don't really have corrections so much. There are two high pulls that I can see here. Let me just identify them really quickly. I'm going to make the line slightly thinner. So we had our breakout right here. So right here was our breakout, and it went up above, so that's the resistance line it passed. It then reversed down below the 50% line, which was right here. So that O is technically a high pull warning. And it was a reversal from $132 down to $122. So it wasn't 10%. It wasn't a full correction, but it was a high pull. And from there, we had the price correct back up to its high point right here at 136. But because it was only 2 boxes above the previous column of X's, this is not a high pull. What this could be called is a bullish trend, because you have buy signal here, buy signal here, buy signal here. You have 3 double top breakouts that are going up and up and up with no breakdowns, no sell signals since then. So that is what's called a bullish trend. It's going up, small step back down, up, small step back down, up, small step back down. So that is the trend that we're seeing coming up with Moderna. So correction, no. But high pull, right here, yes. That O would be a high pull. Elizabeth is asking, when a stock is at its highest price in the last year, can it only go up, or does it usually mean it's going to go back down? That is a great question. It really depends on the stock. Some stocks may have a high point because they're just on their way up. Stocks over time will tend to go up. So because the stock price is usually going up, highs and new highs will continue to be hit. But it's hard to know where that top is. And that's why we look at things like pivot points and resistance barriers to be able to know if it's going to turn around where do we think that turnaround point would be? And following those, the pivot points, and we have webinars on that, as well as following the previous resistance barriers, is important in knowing the direction that it's headed and how much we can rely on that direction. Typically, slower, more consistent change will hold on a little bit more than fast jumps. And because it is a big talk of the market right now, let's take a look at GameStop. GameStop has suffered in the past year or so, to say the least. But towards the end of the year, there was talks about new funding and new leadership for the company. And in early January, that leadership made the news. And, well, this happened. When this happened, we see that the price took off and it skyrocketed. That's the clear button. Then what? The stock price went up above what people thought it was worth, went back down, up, down, up, and we see how the price was bouncing around about right here or so, around $40. But something changed today, and because of that, we see an unnatural amount of growth. Before I end it, both the presentation and this slide, or this example, what has it done since? It reached $76, but it's already corrected. Look at the price that it closed the weekend at, or the week at. It closed at $65, down from $76. So it took off way past where investors thought it was actually worth. And once it hit the ceiling, it bounced off of the ceiling, like me on a sugar rush, and now it is on its way back down to $65. And let me actually look up. GameStop's after hours is now down to $61.50. So looking just right here at this chart, and I'll make it a little bit bigger, it went up, 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 huge growth, and then went down and has kind of flattened out since then, with changes in and around the about 62 on the high end, maybe 65 on the high end, and now is beginning to go back down with a lot less volatility and a little bit more consistency, resting somewhere around the $62 to $60 mark. So on Monday, be ready for a column of O's from here, probably down to about right here. Not a high pull morning yet. A high pull would be down here, but well on its way down from its high point of $76. So what would this be? Well, you guys tell me. Is this a correction or is this not a correction? Bless you. Is this a correction? Is this not a correction? We're looking at GameStop right now. So this is GameStop's stock. So we are looking at how it grew over the past couple of weeks, and then today took off, but has already started to go back down. And as everyone in the chat is guessing correctly, or not even guessing, you know, because we've talked about a correction is a change of 10% or more. That is a correction. So you all now know plenty about corrections, what a correction is for both a stock and a market, what a bear market is, how they're similar, how they're different, and how to look for corrections on stock charts, as well as try and figure out where things are going from there. The last thing I want to leave you with is you can go over here to charts and tools, and on the left side, predefined scans, or on the right side, I apologize. And if you scroll down under point and figure patterns, you can find more examples of both bullish triangles, bearish triangles, as well as high poles and low poles, if you want more examples or to see what these charts look like for yourself. Thank you all so much for joining us today. It was a pleasure to see so many of you enjoying the presentation and the examples. As always, please give us a like and a subscribe. We will do these webinars every single Friday at 4 p.m. Pacific time, 7 p.m. Eastern time. So feel free to join us for next week's class, where we'll have a new topic to talk about together. Until then, thank you all so much for joining us. It's been an absolute pleasure to have you all with us. And if you're ever interested in the other webinars we've done, you can take a look at our website, sectorsmadesimple.com, where we have all of our free webinars recorded and, I got something in my eye, and available for you to watch anytime you'd like. I am now one-eyed, so I'll just say this. Goodbye. Thank you so much for joining us, and we'll see you all very soon. Take care, everybody. Bye.